Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scheper.
All right, Chapter 4, the perfect industry solution. When there is a huge disparity between one type of system and another system, like the non-taxable benefits versus the TL2, what should the owner-operators do? And there's a difference here. Realistically, the point of the book, bottom line, is that lease owner-operators in Canada should be using non-taxable benefits if they want to truly save a significant amount of taxes. That's the bottom line. When it comes to company drivers, that would require carriers to actually have an employer-employee agreement and pay cents by the mile as well as a daily per diem. And that, under most circumstances, is probably not going to work.
No.
It's very difficult to implement. We did advise the other day, there was somebody who had some employees. They had a scheduled run between one place and another. You knew where the driver was at all times. There was no flexibility. Everything was absolutely identical. To put that person cents per mile and per diem actually makes good sense because everything is totally predictable. It's a scheduled run. But if you throw a truck driver, and you tell them go from Toronto to Texas and then Texas to Vancouver, Vancouver to back to Toronto again, honestly, you can get two identical trucks going. They start out side by side. One guy could get there 3 days later than the other guy. It increases the cost to the carrier. It makes the predictability of bidding on a job too much variables in there. They could lose money too quickly.
If a guy has more than one truck, let's say you have two, three trucks, you could do that. You could do it yourself. But any company to do that for you,
there's too many variables. But even you have to really, there has to be a good, solid relationship between the employer and the employee in order, because there's trust both ways. In theory, a guy could say, you know what, he sends him down to Las Vegas and he disappears for 5 days. Can't get a hold of him or something. Well, my phone was, not working or something like that. But legally, the carrier has to keep on paying him the per diem.
Correct.
And that would lead to significant abuse. And my sympathies to carriers, because they can't really implement it. But it can be implemented to independent operators. Now, it's at this point in the book that I introduce the difference between independent or lease operators and owner operators. Being an owner operator, oftentimes it's a universal catch-all phrase for all different types of businesses in the trucking industry. I separate lease operators from owner operators, and leasing versus owning has nothing to do with the financing situation of the operator. It has to do with how the operator is being paid. If you're on at a company that gives you, $1 a mile plus 20 cents for fuel or whatever, and it's a flat rate fee, that flat rate fee, it would be considered a lease. You're leasing it by the mile. An owner operator is somebody who gets paid percentage.
Correct.
And that can vary all over the place. They're two extremely different business models. In my opinion, it's easier to go from a company driver to a lease operator than it is from a lease operator to an owner operator. Because when you're an owner operator, you have to know what's the freight rate you're hauling for. Is there going to be any deadhead miles? All the different questions that you have. What's the lanes and loops and risk factors of everything that you're dealing with? A lease operator is just straight cents per mile, and their mindset is miles, 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 miles. The more miles you get, the more you get paid.
But lease operator too, it can be a difference between you finding your own loads, or you have a dispatcher that finds loads, or no?
No, it's generally the carrier finds all the loads. An owner operator who runs percentage can often be, in the middle of Georgia or something like that, and they haven't found a load for him. So he's looking around, he can find something, and he can tell his dispatcher and say, hey, wait, there's a load over here that we can go on.
Yep.
and he works much closer with the carrier to find the load. In theory, I guess a lease operator could find a load, but it's very rare. They're looking at just miles. Realistically, an owner-operator should always have the ability, in my opinion, must always have the ability to say no to a particular trip. He looks at it and he says, not paying enough. I don't like where it's going. I don't like the freight. I don't like the shipper. Whatever it is, he says there's too much risk involved. An owner-operator has a vested interest in the freight moving. And a lease operator is somebody who's just pulling somebody else's trailer and getting paid cents per mile, and that's it. Very, very different business models. Actually, somebody who's an owner-operator getting paid percentage, that's the other way of terminology of it. Somebody who's running percentage, to go out and get their own running rights and become their own carrier, most of that is just paperwork. Mm-hmm. It is very little business model different. You're learning the basics as an owner-operator. But from a lease operator to an owner-operator, big difference in business models.
Yeah, I've been a lease operator for, 27, 28 years. Yeah. And you never think about looking on a load board somewhere. Yeah. I have, but it doesn't help me nothing, because if I would call dispatch and say, hey, there's a load over here, they would say, why are you doing that?
Yeah, exactly.
But as you look on a load board and you say, hey, there's a load over, and it's 200, 300, 400 miles away. Say, hey, that load pays X number of dollars. Call them up and say, hey, look, have you looked at this load here? Yeah. So I'm willing to deadhead 400 miles to get that, then running for half that rate.
Sure. Yeah, under vast majority of times, a lease operator is just saying, get me going, keep me going. The only time I should be parking my truck is when I'm sleeping or when I'm home.
Right.
That's the only thing. Whereas an owner-operator, hey, it sometimes pays to stick around a city for a couple of days loading LTL or something else like that. Now, when you're going an extra, 1,500 miles or whatever, you can make some pretty good coinage with LTL as opposed to otherwise. It's a much different business model to work with. But whether a person is a lease operator or an owner operator, or I put under the same banner, I use independent operator, refers to both of them, you have the capability of using non-taxable benefits. The way to do that is through the incorporation process and set yourself up appropriately. A lot of people ask the question, where did that original idea of going through the incorporation and do that, where did it actually come from? I actually did a little bit of research on it. I actually wrote a blog a number of years ago on the history of it. This is what I was told. There was an oil company out in Alberta, or Alberta, Saskatchewan, in that area, Alberta, Saskatchewan, BC, and they wanted to do a joint venture with a trucking company because there was a whole bunch of work to be done on a seasonal basis. So they would do a pile of work in a particular season, then do nothing for 3 or 6 months, whatever it is, and then a pile of work, and then back and forth. And what actually happens in that situation when you work sporadically like that, their GST returns, I mean, suddenly they're huge, and then they're nothing, and then they're reverse, and it's all over the map. Mm-hmm. And that flags an audit. And so they sent out an auditor to investigate this trucking company who was working in conjunction with the oil company. And the controller at the trucking company had a good relationship with the CRA auditor, and he was talking about how the individuals in the oil field were getting this non-taxable benefit. It's called a meal and living allowance on there. Now, the specific thing that he was talking about, referring to, is still operational today, except it's highly specific to a particular industry, and if you don't have that industry code, you are not able to use that system. Highly refined system. Actually, there was a CBC article a number of years ago that dealt with it. There was some trucking companies who are working for a qualified company, but they themselves were not submitting under that code. Okay. And so all of the non-taxable benefits they were using was not allowed.
Okay.
Because they followed a different route, and so it was reversed, and apparently rightfully so. But that doesn't mean that non-taxable benefits can't be associated with long-haul trucking and independent operators. So anyway, the controller was talking with the auditor and saying, man, the trucking should be able to be allowed to do this as well. To which the auditor says, well, why don't they? And he says, well, we can't. And he says, sure you can. He says, all the independent operators have to do is go through the incorporation process, set themselves up properly, and then use it themselves only within their own organization. Fabulous idea. They all laughed and giggled about it or whatever. And that was eventually forwarded to Jim Park from Highway Star, who wrote an article about it. This was back in 2004, 5, something like that. And that's where the real origins of it. So it actually came from an auditor. Thank you very much. See, not all auditors are bad people in there. Some of them are pretty smart. I've actually worked with a few of them that taught me a few really cool things about GST and the like, because working with a bureaucracy is sometimes a nightmare. You need to know the dial codes to just get the frequency just perfect. Sometimes it's a little bit maddening after 20 years, though. But anyway, so that's where the origin of utilizing the system is. Now, it does fabulous for income tax, just beautiful. There are some disadvantages of it, though. First of all, obviously, it's complicated. The average truck driver has to be trained in using it, not just setting it up, but also using it on a regular basis, because you have to have the audit trail for the auditor to be able to show compliance through the system. So it's complicated. There's training involved. That's a pretty major factor. The second disadvantage is that it is about 2 to 2.5 times more work for an accountant or a bookkeeper or tax preparer. And consequently, it's about 2 to 2.5 times more expensive to actually pay an accountant on there. So a person really has to think about value. We've been doing this now for almost 20 years, and we've had some people say, for instance, we charge, give or take about $2,500 in a year. And there's some people who say, I can get my corporate T2 done for $500, which is insane. There's a whole bunch of holes, I think, in that situation, but $500. Well, first of all, they're not using non-taxable benefits. There's way too much work involved in qualifying for any accountant to be only paid $500 for it. Even if you had all of the paperwork right down and you do it, do a whole year's worth of paperwork, it would be perfect. It's still, the rates, you would be outrageously, who works for $5 an hour or something, Right. It's just not doing it. So they may be able to pay somebody $500 to do their corporation, but they're paying an extra $10,000 in taxes, unless of course they're lying. But let's say they're not lying. They're saving, say, $2,000 on one hand, but they're losing $10,000 on the other. It's just a huge disservice to themselves. So you have to think differently. You have to think, where's your true value? Mm-hmm. And basically the difference between the TL2 and non-taxable benefits is we basically say between 5 and 6 times what is paid to us is what the client saves on taxes. So there's a 5-to-1 return on your investment, which is fabulous. So it does cost more for sure because of the added work. There's another factor. When the average truck driver in Canada makes $65,000 a year and pays taxes between, this is national averages, pays taxes between 12 and 20. That's national averages all across the board. When they're using non-taxable benefits, instead of claiming 65, now they're suddenly paying 35, and they're paying taxes between $2,000 and $10,000. Okay. Well, when you're only claiming $35,000 worth of income, you're under contributing your Canada pension plan. And so when you're thinking long-term for retirement and the like, you have to realize that you're not fully contributing to Canada pension plan. Now, some people think Canada pension plan isn't really a pension plan, it's a tax, but I don't know, it's a different topic.
Yeah.
But realistically, it has to be taken into consideration that you are saving some of that in Canada pension plan, and so you should beef up your retirement plan. Whether it's probably an RSP would probably be better. Just put an extra few $1,000s a year into that. which gives you better return anyway than a Canada pension plan. But that is a disadvantage, but you can work around it. There is another one, and that is, let's say, for instance, historically you're making $65,000 a year, and you break your leg. You get workers' compensation. Different provinces call it differently, but basically workers' compensation. WCIB in Ontario, WCB in Manitoba, and every province has its own because it's provincially administered. Workers' compensation calculates your benefits based on your T1 or your taxable income. And so they would say, okay, well, you've only been making, when you're 60, 65, you'll get X amount of check, dollar. But when you're only making 30, 35, now suddenly it's almost half. So it's not a survivable amount that you're allowed. So you really have to reevaluate the insurance that you're getting. If you're getting disability, downtime, that kind of thing, insurance. Not downtime, but disability insurance. And again, when you're going hunting for insurance, it is the 95% of all disability insurance, again, is locked to your T1, your taxable income. So you have to look at that 5%, which is you give X amount of dollars, and no matter what your T1 says, you are getting X amount in remuneration for that. And that's the type of insurance you have to buy. So you have to compensate for the drop in taxable income. There is another a disadvantage that is, to some people, it makes no difference, and to some people it's a massive difference, and that is bank borrowing. I know you had some difficulties originally when you were doing it, when you were buying and selling a house or so. And because some financial institutions look at your 60, 65 or your 30, 35 and say, wait a minute, you can't borrow for that.
Right.
In there. And sometimes I know you used
we used a broker.
Yeah. They had searched around and was able to find it. Our experience is Caisse Populaire and credit unions tend to accommodate the non-taxable benefits, whereas chartered banks, they just basically go on your credit score. And
but not even that.
Yeah, because you had a huge.
Our credit score was like almost at the top.
Yeah,
and they wouldn't even look at us. Not our. We've been at this bank for, my goodness, 20, 30 years, and they wouldn't even look at us.
Yeah. A little bit has to do with the loans officer that you go to. Sometimes he's a little more than a glorified teller.
Not even that. We went to two different loan officers at the same branch. They wouldn't even look at us. They said, "There's no way that you can borrow this money."
Yeah.
So we ended up going to a broker, and they then put your name into a hat, and then they throw it out there and then whichever bank grabs you. But it will not be like a Scotiabank, TD Bank, Royal Bank. It will not be one of those
chartered banks.
No, it'll not be a chartered bank. So even with the investors, they looked at it and they said, no way.
Yeah.
So anyway, we ended up at a credit union, and when he looked at even our score, our credit score, like he said, like, why in the world would nobody pick them up?
I've been in it for 20 years, and we now I've done presentations at some fairly large credit unions who absolutely adore what we're doing. Because, I mean, if you can save a truck driver, $12,000 a year in taxes, it phenomenally increases their cash flow.
Correct.
And which greatly reduces the risk of the financial institutions, so they're laughing. Yep. So they love us. They even changed some of their computer programming so that they can put non-taxable benefits straight in there. And it'd be interesting to know whether they do that for like either the oil industry or the airline industry, because they all have non-taxable benefits. RCMP collect it, and a whole bunch of like government employees do and stuff like that. So I don't know whether they universally don't acknowledge all of it, or just because it's so rare in the trucking industry to do it.
I even got a form from your office as to what you guys do, and I brought it to them, but it made no difference.
Yeah. And yet, having said that, there are some charter banks who will do it. And I think a little bit has to do with who the branch manager is, what he does and what he doesn't do. It could be, I don't know. It's very inconsistent.
In our case, in the branch that we are at, it was the investors that just flat out declined it.
Sure. And I think the entire financial industry has to accommodate this if they really want to do it. I had a client was going through this whole process with them, telling them what we do and how we do it and the impact and stuff like this. I got to this disadvantage, and all of a sudden he stood up, and I a little bit shocked, and he says, "You mean to say I can't borrow the maximum amount I want at the bank?" And I said, "Well, probably not as much." "Well, that's it." And he turned around and walked out.
Oh, wow.
Yeah, and it was like the primary reason to use a bank is to leverage and get every penny you can out of it. So his long-term philosophy was debt to the ears,
Yeah.
And realistically, I'm sure within 2 to 3 years that guy was bankrupt anyway, because you leverage right out and eventually you just collapse, in there. So if you're a serious business-minded person wanting to build after-tax wealth, you got to do this. You got to accommodate this. Realistically, the way life works, when you start at 20 years of age and you go out to 60 or 70 years of age, when you're young, you should probably, you may have to use some credit sometime. For sure to buy a house. But the older you get, the less and less you should be borrowing.
Correct.
And
absolutely,
at some point in time, you shouldn't have to worry about your credit rating at all, because I haven't looked at my credit rating for probably over 10 years, 15 years, because I don't care. I know a guy who's borrowed millions of dollars. It doesn't make any difference what his credit rating was, because he had equity in everything that he was doing. Mm-hmm. And realistically, he had a clean record as well, but bottom line is he get loans like that. If you put up $1 million for something and you're only borrowing $200,000, well, bank says, okay, sign here. They don't care, So as you get older, you should have more equity. You should build up so that you should not have to do any borrowing later on in life. Right. And a little bit like that when you're with the life insurance too. Life insurance when you're young and you have a young family and kids or whatever, you should get life insurance to cover your income. But as you get wealthier and wealthier, in theory, as it goes, your life insurance should drop off, become less and less. In theory, at some point in time, you don't need life insurance anymore because everything is covered in there. That's the direction that we should do it. Now, when you talk to bankers and insurance salesmen and stuff like this, they don't say this. They say, "Oh no, you'll always need banks. You'll always need insurance. You'll always." No, because they're selling their product. But in realistically, if you want a nice solid retirement where you feel free and you can come and go as you please, kind of a thing. You don't want banks to be knocking at your door. You don't want to have any. Nope. You don't want to owe anybody anything in there, and you don't need extra money once you're dead anyway. Last I heard, anyway.
Yeah. Last time I went to the bank to buy a truck, I had like 35-40% down, and they still didn't want to borrow me the rest. And I told her, I said, "Look," I said, we'll pay it out in 1 year."
Yeah.
And again, it was a corporation, right?
Yeah.
So, and I knew that. And it took 2 weeks before they would borrow me the money. Yeah. And then I told her, I said, "Look," I said, I only want to borrow it for a year. And I said, "I'll never borrow money from you again for another truck." And she said, "You'll be back." And I
never were back?
I was never back. And I bought many trucks since then. And I've never been back.
Oh, that's awesome. That's great. Now, the final disadvantage of using the non-taxable benefits is liability. Obviously, just think of it from a common sense perspective. If one driver or one operator is allowed to save $12,000 in taxes, and an auditor looks at it and says, "Oh, man, if it was a simple little thing, all I could do is say no to this and boom, and suddenly I saved the government $12,000. Okay, if it was really easy for to implement or to reverse or so, it's risky. I guess you'd say. I don't know if I'm explaining it's totally right, but other than the person who has to defend this has to be the accountant. A couple of chapters we talk about choosing an accountant, but when it really comes down to an accountant, One of the reasons why they don't use non-taxable benefits, and I've talked to accountants all across Canada, is that number one, it's a labor-intensive, low-margin industry, so this whole entire thing is in low-paying freight. That's what an independent operator is. But the next thing is there's a lot of liability, little bit of money, not really worth it. But another factor that's in there, historically, accountants are the ones who say, yes, we're going to do this, and no, we're not going to do it. They are the gatekeepers of what's acceptable and what's not acceptable, and whether you qualify or whether you don't qualify. The difficult part about non-taxable benefits, it's a combination of both the operator and the accountant both being gatekeepers.
Correct.
The accountant can do everything perfect, and it still falls through the cracks because the operator doesn't comply. Or the operator can comply, but the accountant doesn't, and then the thing can fall through. It is joint liability. There's virtually no history that I know of in the accounting industry where there's joint liability and the accountant sleeps like a baby. It's just like they want absolute control if they're liable for anything. And realistically, they will say, okay, maybe we'll do it, but we're not going to be liable. And that's why, in my opinion, a lot of accountants just don't do it. The liability and the joint liability issues is just far too complex, and it doesn't work out. Realistically, the only way, in my opinion, to implement this is that the accountant has to have a vested interest in the success of non-taxable benefit defense. Our firm, I know I'm promoting our firm again, but our firm, we have 99.9% of all of our clients are lease owner operators. That's all we do. That means if just one of our clients gets the door shut on them, really I'm putting up the whole entire firm is at risk, because then all of them will domino down. And so realistically, I have a vested interest in the success of non-taxable benefits for all of my clients, period. Now, if there is some clients that are absolute, maybe for lack of a better word, use the word loopy, and they just don't want to comply about anything, we warn them, and then we say, okay, that's fine. You're not going to be covered. And we have to do that for the betterment of everybody. But really what we do is we're looking for serious business people that want non-tax, or they want after-tax wealth when they're 60, 70 years of age, and building up for the future. That's the system that the independent operators all across Canada should be using. There's another disadvantage as well, and that is from the date of incorporation forward, you can start collecting non-taxable benefits, but you can't do it before. So I've been asked this many times, when is the best time of the year to incorporate? And I say now, because every month that you go by, you lose about $1,000 in taxes, in taxable benefits. So realistically, if a person is self-employed, then from the date of incorporation, he can start saving. But prior to that, he's still stuck with the TL2.
Thanks for stopping by Making Your Miles Count. For further Making Your Miles Count productions, call us at 877-987-9787 or download us at makingyourmilescount.com.